But you see, all this hinged on things that were made of air. They were made of air, eventually created by the sound of the Fed's computers as they rang up more and more bank deposits. The M2 definition of money grew about 2.5 times as fast as national output between 2001 and 2006. So money is plentiful. Money is easy. Interest rates are low. And it spills out onto the whole world, which to some extent goes along with the same kinds of stuff. So here we have similarities in the lead-up. We have some similarities in the bust as well. The U.S. market, of course, began to tank seriously last year, over a year ago, and has lost, well, at one point lost about half the value of the stock market or thereabouts, depending on which index you look at. So huge losses were sustained. I was reading something on the plane coming up here today about how by the end of last year, $8 trillion of losses had been sustained in the U.S. stock market alone. That's a lot of money. I know I lost some. Not that much, though. Not even my pro rata share, because thanks to my training in economics, I shifted into bonds early on. So I lost some money, but I didn't lose what these dreamers lost, who stayed with the stocks all the way down. Now, of course, back in the early 1930s, the stock market fell tremendously in late 1929, and then it started up again. Okay? And there occurred for about 4 or 5 months what has come to be known to historians as the suckers rally. Because there were all these happy-faced guys, like, you know, it's hard to believe, but Herbert Hoover, who kept telling people, you know, this was just a minor thing, it would pass, everything would be okay. And, you know, the economic geniuses like Irving Fisher, the greatest economist ever produced in this country. Just ask anybody with a degree from the University of Chicago. They'll tell you. And Irving Fisher was a guy who was a millionaire. He had made, and he had proof in his pudding. Okay? He didn't just talk a good game, he got rich. And Irving Fisher was telling people, don't worry, this is just a small adjustment, this will pass. Fundamentals are sound. So some people took that kind of talk to heart, and they started buying stocks again toward the end of 1929, and for the next 5 or 6 months they bought stocks. That most of the losses went away. The stock market was made up more than half of its losses. Life is good. But not after that, because the suckers market ended in the spring of 1930, stock market turned down again, and by the time it hit bottom in the summer of 1932, most of the U.S. stock indexes had fallen at least 85%. So this was not just a depression for poor people. Rich people took gigantic whacks as well. They lost tremendous wealth in the stock market and in other ways too on the way down. And as I was saying just a moment ago, the same thing has happened in recent years as investors in stocks and derivative securities of various kinds have lost their shirts and then some of their other garments as well. So there's a similarity. The difference, I think, that it's important to notice here is that in the Great Depression, the decline went on and on and on for years. It really lasted almost 4 years before things began to level out. And then they didn't improve very much after that. Some of the measures make it look as if things improved rapidly after 1933, but I admonish you to be careful in interpreting those indexes. They're tricky. Recently, we've had a decline in national product of about 4% from the second quarter of 2008 to the second quarter of 2009. We don't have the data yet for the third quarter. It probably isn't terribly different. So 4%, you know, you'd think that's not so much. Well, it was enough in a world geared to growth, assuming growth, making plans on the basis of growth. Having a 4% drop in national output makes a big difference. However, between 1929 and 1933, GDP fell by about 30%. 30%, okay? Recently, we've had hundreds of bank failures in this country, and other countries have had a number of bank failures. But between the beginning of 1930 and the end of 1933, we had 10,000 banks fail. 10,000. That was about 1/3 of all the commercial banks operating in this country before the crash. So we're not in that area at all yet. Well, the government took active measures then and recently to deal with these troubles, and some of the things that were done are similar and some are different. I would have to say that the Hoover administration did almost everything wrong. And that wouldn't have been so bad, except that Herbert Hoover was an activist, progressive president who believed that the government should intervene strongly to offset economic downturns. See, when the economy turned down sharply in 1920-21, the federal government was run by people who thought they should do nothing. And that's what they did. Basically, they did nothing. And that depression was over in about 2 years. Completely over. The unemployment rate in 1923 is only about 3%. 3%. 1921, it had been over 10%. It had been probably around 11, 12%. So this was a sharp but very short depression because prices fell greatly, and falling prices helped to reorganize an economy in contraction. Makes costs lower for people, tempts them to start up production again. Okay? Makes their money buy more. That's what we call the real balance effect in economics. Gives more purchasing power to the dollar than it had before prices fell. So all of these things helped, but the most important thing in 1921-22 is the fact that the government did nothing. But ever since 1929, when there's an economic downturn, governments have been doing something. And virtually everything they've done has, in my judgment, been for the worse. Hoover signed a tariff bill in the mid-1930 that raised tariffs to the highest level in American history. And this was a high tariff country in the late 19th century. So that was saying something. Huge high tariffs. Other countries, even before this bill was signed, retaliated. And after it was signed, more retaliated. So we had a trade war. Okay? Think back to the 19th century. Economic progress, growing trade, growing division of labor, rising incomes. Now you've just turned that around by setting off a trade war in which every government tries to protect its own producers from competing imports by raising taxes on those imports. This is one of the most self-destructive measures any government can take, and it's one that every government finds itself pressed to make when economic contraction takes place. The current government is finding itself pressed now in this country, and it's unfortunately begun to respond to those pressures. The government raised tariffs recently on tires imported from China. Of course, the Chinese turned around and raised tariffs on American poultry imported into China. And so it goes. And we can only hope it is curtailed before it becomes as destructive as the tariff war of the early 1930s. So that was a very bad move by Hoover, but it was not the worst. Even worse was the fact that Hoover was a great believer in a kind of crude purchasing power theory of the macroeconomy. He thought that the economy worked best if wages were kept high because the workers earned a lot of money and then they would turn around and spend it. And that would keep the producers' mills running.